Three, two, one.
Hello, everybody. This is Michael DeGioia, and this is the Dash Trader Newsroom, and we are covering the 1 year since the pandemic started, the new normal. And as always, I'm joined here today by my co-host, Jill Malandrino, global markets reporter from Nasdaq. And as of course, I am the director of institutional sales, and I also work on education here for Dash Trader. Jill, how are you today?
I'm doing well. I can't believe it's been a year. It's also my dad's birthday, so happy birthday, Dad. It's been incredible what's happened over the past year, not even within the markets, but just with us and who we are in our place in the planet. It's just been quite a year. And I feel like the news that we've heard this week, it feels like we're starting to talk more about getting to the other side. So
there is nothing normal about the new normal, as far as I'm concerned. I don't know how you feel about it, but certainly, as I sit here in absolutely freezing New York, and you're not too far away in New Jersey, but it's like global warming got replaced by a new ice age, as we've had snowstorm after snowstorm. But speaking about some of the things that we've seen over the course of 1 year, if we were to go back 1 year, Bitcoin was at like 3,000 to 4,000. It had dropped from 9,000 to 3,000, 4,000. And now just recently, Bitcoin has hit the $1 billion market capitalization mark. So what are your thoughts on cryptocurrency? I know you're a big Ethereum fan. What are your thoughts about Bitcoin and this massive market capitalization and the reversal of fortune of this digital asset?
Yeah, it's quite incredible. I mean, hitting $1 trillion of market cap, it's really quite incredible. In fact, I'm looking at my Coinbase account now, and even in just 1 day's movement, it went from 50,725 to 55,781. So, you know, that's 6.75% of a move. Coinbase a little bit more flat on the day, up about 0.75% at 1956. I personally own both of them, skewed more towards Ethereum. I understand and appreciate the practical applications that the technology has for blockchain and decentralized finance, and how the world is just gradually making that seismic shift to how we will look at finance in general. I would say certainly in the near term, certainly for the longer term. And it's, the question that I ask when I have Bitcoin guests on my show, Grayscale comes on, Celsius Networks, all the big players in the space. And it's certainly not 2017. The institutional adoption of it, the tools via the futures market that are there to allow crypto managers to hedge and so forth are there. There's more of a solid infrastructure. We're hearing almost day to day of the Square, PayPal, Tesla, BNY Mellon type of headlines hitting. Then you also have the launch of the Canadian Bitcoin ETF out of Purpose Investments. I had the CEO on my show. I believe it was on Tuesday, and that particular ETF had acquired the most assets under management for any ETF in history. So there certainly is the appetite out there for it. So it's almost like the ball's in the court of the US regulators now. I had on just this afternoon the head of ETF asset servicing at BNY Mellon, and he really thinks that the year 2022 is going to be the time that we will see something hit the market in the US. I feel like it's a great thing for investors of all types that will provide them access to this market. And retail investors are more familiar with the ETF wrapper, and they might feel a little bit more comfortable utilizing that type of product. Same thing with advisors. So it certainly is exciting. It's certainly where I believe the future is going. And my homework that I want to work on in the crypto space is to understand the applications of all of, let's say the next top 15 to 20 crypto assets that are out there. So that's kind of part two for me.
Yeah, absolutely. I'm very interested. I mean, there has been this talk about this Bitcoin dominance shift, right? So the beginning of the move starts with Bitcoin because it's the kind of the premier digital asset or cryptocurrency, the one that came out first. It's the benchmark. It's beta. And then obviously there's Ethereum, which is kind of the first runner up. And then that spread goes down to these altcoins, right? And these altcoins finally start to follow suit. And there's so many altcoins, you don't quite know which one to follow, which one's going to succeed, which one is going to endure. And I think that that's kind of at the point where we are now, is that after this explosive Bitcoin move, the follow through has gone and continued as Ethereum, butts up against 2000. And the question is, which altcoin is going to be the winner from, for DeFi and all the other various different reasons that these altcoins exist. But I think that as we look at it, we see the entire marketplace is just so small compared to the rest of the equities market, the rest of all the other markets that are out there. So there really is still a lot of growth in digital assets and cryptocurrencies across the board. And that really brings me to 1 year ago. What was going on was Donald Trump was, in the midst of hammering China with some trade tariffs. It was actually about 5 months after the trade talks with China. Donald Trump had really gone after China to kind of revise the way that the U.S.'s trade relationship works with China. And then today, of course, we have Biden talking tough against Chinese trade abuses and economic coercion. And I really I'm very interested to hear your thoughts, Jill, on how the tone of this argument, because it seems like different president, same problem, but in many ways, it seems like the problem has gotten far worse over the course of 1 year. Yes, maybe there's some silver linings in it. So I'd be very interested to hear, your thoughts on China going forward, because from a very patriotic, nationalistic perspective, I think the United States has a lot to worry about China, as it currently stands. It's a very, very dangerous adversary in this world environment as of right now. So I'd love to hear your thoughts.
Well, it's really interesting. And I think this highlights just how complex the diplomatic situation is, and that you can't conduct strategy or diplomatic relations via a tweet, right? It just adds to, it's just another chaotic element that is completely unnecessary. We see what that does to the market. I'm curious to see how this plays out, that this is going to be looked at through, I guess, more appropriate diplomatic channels, if you will. We're building back up the State Department. We're building back in career civil servants and ambassadors and so forth. So curious to see how this is going to end up playing out. But yeah, when we think about adversaries, it's probably very different than when we thought of adversaries during World War I, II, even Vietnam, I would argue, even the Gulf Wars, I would argue, where it was more of physical adversary, whereas now the wars that we're fighting are being done, in the cyber universe, and that requires very specific skill sets. I think the damage that can be done from that perspective is almost it could be even more dangerous than the physical part of it. So it's interesting. Both countries were relying on each other for so much, but I think the stalemate that is going to exist is the part about big data and even when you think about it from the exchanges and so forth, right? Like, they don't use a lot of the technology from global exchanges within theirs because they consider it, a matter of national security. So I think when we think of China, it's more from a cyber perspective than anything else.
Yeah, absolutely. I think that the threat from China, though, is manyfold. If you go look around the world, I know that recently I was in Brazil, and the largest trading partner of Brazil is now China. Many African countries, the largest trading partner has become China. China has literally reached its tentacles all around the world. from an economic perspective, but also it's also flexing its muscles from a military perspective in the South China Sea. The launching of its own of their own aircraft carrier, which is a key military way to exert political power around the world. And I mean, that's a direct affront against the United States, right? In many ways. And the rhetoric is constant. I mean, I even read an article about Biden talking about Chinese civil rights abuses, and the Chinese newspapers were attacking Biden about not being able to keep the lights on in Texas. So I mean, the Cold War of words is certainly heating up, and it's not just one administration. It's not just Trump. The Chinese economy is set to overlap the U.S. the size of the U.S. economy at some point in the next 4 years, sometime during the Biden administration. So I think that the conversation as it relates to China, I mean, from my perspective, China is the new Soviet Union. Like, we had an adversary in the Soviet Union in the United States. Now we have an adversary in the form of China. And it's not just, it's a totally different form of capitalism. It's kind of control capitalism, which is very, very pointed, very, very directed. And it's really the first serious threat that the United States has had since the fall of the Soviet Union and the end of the Cold War. And it's going to be very interesting to watch how Biden approaches this, considering all the rhetoric that we've heard from the prior administration and now even from him. So.
Yeah, I would agree with you too. I used to cover African markets when I was reporting for Voice of America, so know them fairly well. And it's really interesting how China has made the inroads so for example, they've done a number of infrastructure investments, building railways and so forth in the Eastern Horn of Africa, which includes Kenya and those key countries along the port there. And they've made other investments. And the thing is, when we think about fintech and where the growth and the opportunities lie, the continent is by far, I think, one of the most attractive places in the world. And, with China inserting itself more they're certainly going to have a big influence. And I think that's something that we need to think about as well, because if you have, the amount of people that live in Africa, the amount of people that live in China, and you combine those forces, it can make things more challenging. And we dialed back on our U.S. African investments pretty significantly over the past few years. And I'm curious to see if we will build that back up again. I've worked with a number of African trade associations. I've met with the CEOs of their leading exchanges and so forth there. And that has always been their concern, because we went from a model of aid to trade to institutional investment with Africa, and it just kind of fell off a cliff. So I'm curious to see how this administration approaches it.
Yeah, so basically the United States created a void, and then China stepped in to fill it just as that void was created. And it's not just Africa, it's also South America. Obviously the dynamics of whatever went on with the pandemic, certainly may have affected some of China's stature in the world, in that China, was the origin of the pandemic. But at the same time, the way that this all pans out is going to be very interesting to watch. And certainly, I don't want to, I want to stress that we need to be very aware of this potential adversary in trade, in investment, and certainly the dangers of kind of corporate espionage and whatnot. It's certainly much more heightened after 1 year. The title of today's show was "The New Normal: 1 year after the pandemic," and I would say that everybody in the United States, everybody in the world, is much more aware of what's going on in China than they were 1 year ago. And I think that that's certainly part of the new normal. And the new normal as it goes to the market is that the market quakes when the government talks. And Janet Yellen talked about more stimulus today, and the market gapped up. It certainly doesn't look like that talk had legs, because the market has kind of melted from that initial gap up. But it seems like after 1 year, instead of the market reacting to the normal forces, it seems like the market's biggest prime mover today is government involvement, which is far, far different than 1 year ago. And to me, this has been the trend, meaning that the markets have responded to talk of stimulus instead of market forces, things coming from the private sector, technological developments, companies competing. So I'd like to hear, I mean, obviously we know the market always responded to government involvement in terms of interest rates and whatnot, and numbers and data. But I'd just like to hear your thoughts about this current new kind of reactionary expectation for stimulus, meaning that the market reacts and expects stimulus, and that's what it responds to, and what the long-term effects of that will be. Is that the new normal?
Yeah, it's interesting. As we were talking, Mike, I think I was saying that Bitcoin was at 55.7 when we started. It's now over 56,000.
Yeah.
Right. That's how quickly this moves, and it's also a result of all the stimulus that's being injected into the system, because of course you have the concern about inflation and the value of the U.S. dollar. So that's one of the base cases for cryptocurrency, right? I also think that at some point their assets are inflated. I know we've been, and they will continue to inflate until they don't inflate anymore. And I think that has a lot of traders kind of concerned about that, because we will have to pay the piper and take the pin out of this at some point. But for right now, and to the Treasury and the Fed's credit, they've been crystal clear in terms of the message that they're telegraphing. This isn't a surprise.
Yeah.
So it's not like it's any. I think they're going to be very deliberate about how they're telegraphing everything. So
the money printing press is on is basically the message. We're going to keep printing money until we get through this. I mean, what are the long-term effects of just constantly printing money and really, I mean, when do you pay the piper? I mean, I was talking with a good old friend on the floor of the New York Stock Exchange, my old buddy Joe, and he was like, when do you pay the piper? When do the chips get called in? And I'm interested to hear your thoughts on that. When do we heard about this in the financial crisis? The quantitative easing became, QE1, QE2, and then QE infinity now with the pandemic. When do the chips actually come in, or do we just keep printing money forever? I mean,
who knows? There's talk about taking interest rates up. Remember in December 2018, the market had a 20% correction. I mean, it's super sensitive to that. I mean, how much cheaper can it possibly get at this point? But it is going to have to, I don't know if self-correct is the right word, but there is going to have to be some sort of balance at some point once you start factoring in inflation. And it really is so surprising to me. Like we saw that we had the CPI and PPI numbers come out, and they're showing that there is no inflation, which is so bizarre to me, because when I go to, I feel it at the pump. When I go grocery shopping, you can totally see it in your bills and what you're paying. Like it's there somewhere. So the fact that it's not showing up in the data, and of course the data are lagging indicators and so forth, but it's like gas costs more than it did a month or two ago. Like I don't understand how there is no inflation, or there's not much of it is what the narrative is. So, the more they print money, the more they're going to have to tackle this.
What happened with the interest rates? Because I know that there was a sharp increase in some of the long-term interest rates over the course of the last 2 weeks. So I'd love to hear your thoughts on that, because usually that's a telltale sign that there's cracks showing in the economy. Like the interest rates sharply, the bond rates sharply, bond yields. I mean, it was a sharp, drastic it was a drastic increase in interest rates.
Well, the short answer is I'm in the process of buying a home. So of course they're going to start to move higher. Yeah, it kind of, it is a bit of a head scratcher. I mean, that was my first thought went to that as well, but even still, they're historically low. I mean, I think I locked in at 2.875. Like, I mean, that's ridiculously low when you look at it from a historical perspective. And they're really, it's not like it was much better at one place or the other. I mean, think about that. It's to even be able to refi at any point. I mean, how much lower can these possibly go? And you're right. The move in the 10-year certainly was meaningful in the past 6 months, as you had mentioned. And again, short-term, that Fed hasn't done anything. They still remain near zero. So the fact that the yield curve is moving the way that it does is pretty interesting for me to see. So yeah,
that usually is a sign that there's some kind of a drastic shift coming. I just don't know exactly what that shift is. I usually it shows that there's cracks in issues that are forming that are just not quite evident yet. When you see a drastic increase, in one of the yield curves. And again, we just have to stay vigilant. And the title of today's show is The New Normal. The question is are low interest rates the new normal? And certainly, they said new mortgage requests have kind of dropped off because of that change in the interest rates. So you're not going to get the refis, but that still means people need to buy a first home like you're doing, or a new first home for you. I don't know if this is your first home or not, but certainly if you're buying a home, you still got to buy a house to live in if you're going to be getting out of an apartment. So it's certainly an interesting look at it. And so at this point, thank you so much, Jill. I think your weekend is officially starting.
I just have homework to do all weekend. Yay. But no, great catching up with you guys as always. I'll see you in a couple of weeks. And have a great weekend, Mike. Thanks for everything.
Great weekend. See you in 2 weeks. Okay, now we're going to jump to the charts. I'm just going to quickly reconfigure my screens here. And let's bring up my Dash Trader. Here's my Dash Trader software. And I just want to bring out and show everybody this particular chart. And I wanted to just show everybody how we can configure different studies. So here's a study configure. Study configure brings up the little pop-up box that we just see here. Now, already on my charts, I have moving average. I have price candles. I have the 10 period, 20 period, and 50 period moving average. And today I'm going to bring up my MACD. I'm just going to select my MACD and I'm going to hit confirm. Now, I want you to see that on my MACD, okay, what I've done is I've overlaid the MACD on price. Now, if I want to remove the MACD, okay, and this, by the way, the MACD has a histogram as well as the signal line. I'm going to remove the MACD and I hit commit, and certainly it disappears. Okay, now what I'm going to do is I'm going to add a new chart area. And if you notice, when you just right click on the chart, I can go right down here, go to chart area, add new chart area before. Okay. And I'm going to go to study configure. And I'm going to add my MACD. Okay. And I'm going to add my study configure up here. And I'm going to add my MACD. Commit. And I'm going to remove my MACD from down here. Okay. So we have my MACD right up here. And if I want to chart area, I can move it down and put it down here on the bottom. Now, if I want my MACD below my My price volume, I can go on to chart area, and I'm going to go move down. Up. I want to do chart area, move down. Chart area, move down. And now my MACD is on the bottom. I have my price bars, and then of course I have my, these are my price candles. These are my volume candles. I have my my moving averages. Now the MACD, I'm going to talk a little bit about the MACD today. The MACD is the moving average convergence divergence. And usually what we're doing when we're using the MACD is it's giving us a signal that the market is oversold because the moving price has moved below the moving averages. So you can kind of see the histogram represents the dip of the price bars below the moving averages. And then once price moves back above the moving averages, it confirms that the trend is moving up. And if you notice that the signal line stays above, these are the signal lines, these two lines here are called the MACD signal lines. It stays above the zero line or the baseline while the trend continues. Now, we did get a little bit of a deep pullback here, and you can see that's indicated by the histogram here, but the signal line stayed above the histogram for the entire time. And what the MACD is generally used for is for identifying pullbacks and staying in trades. So if you're identifying a pullback, that might be identifying a buying entry, an entry point for you to buy on. If you've gotten into the trade here, the fact that it stayed positive and that the signal line has stayed above the zero line or the baseline says that trend is still in effect. Now, the MACD is a bit of a lagging indicator. And what I mean by a lagging indicator is that it's also called a tertiary indicator. So you have price and volume, which is considered a primary factor in charting and technical analysis. Then you have something like moving averages, which are derived from price and volume. And then you have the MACD. And the MACD is derived from the convergence and divergence of the moving averages. And of course, to a certain degree from price and volume. So you have the MACD convergence, divergence, moving average convergence, divergence, which is the MACD. Now, let's just jump to the charts and let's take a look at some of our charts. And we're going to leave the MACD on here, and I'm going to just scrunch this down because we don't need it to be quite so big. And we don't need our volume candles to be quite so big. Okay, so we got our MACD, moving average convergence, divergence. We have our price, our volume. So let's take a look at the market today. If we notice that the market today has a, we have a high, and then we have a slightly lower high. That is possibly a divergence. And I'm going to throw on one more chart area just so that we can take a look at what a divergence is. I'm going to add a new chart area before. I'm going to right click on here, and I'm going to hit Study Configure. I just added the RSI. So the RSI, or the relative strength indicator, which we're going to certainly cover a little bit in the future, is indicating what's called a divergence. Okay, I'm just trying to grab my little chart area here so I can squeeze it up. Okay, there you go. I want to make it a little bit smaller. All right, well, that's good enough. Let's just do this. Let's take what I mean by a divergence. So if you notice, we had a little high and then a lower high back here on the RSI. And here we made a high and a higher high on the actual price and volume chart. And that's called a divergence. And usually a divergence is a signal for change. And if you notice, we also have the convergence of the signal lines on the MACD. And we have a sell-off today. So we gapped up on the Janet Yellen news that more stimulus is in order. And then sure enough, we have a divergence from price. And then sure enough, by the end of the day, we've sold off, closing the day down. Now, I just want to pop up real quick. I'm going to just change my time frame and jump us to a weekly chart. And if you look at this weekly chart, we've closed down for the week. We opened the week higher than where we closed. So we have a red bar on the weekly chart. And when you look at that, so we're at all-time highs, and we have a red bar on the weekly chart. We've had a divergence in the RSI, and we have a number of indications that potentially the signal line might be crossing over on the daily chart. What that says to me is that we might have somewhat of a pullback week next week from a technical perspective. Let's take a look at gold, GLD. So this is the gold ETF. Okay, and it's kind of rides inverse to this. Gold is at support. Really no indication on the RSI, but certainly gold has pulled back quite considerably. Gold usually is up going into, is usually fairly strong going into January and February. This year, that has not been the case. Gold had kind of peaked out in August, and it has never really seen, the heights of that peak ever since. I want to take a quick look at what we were talking about, GBTC, which is the Bitcoin Grayscale Bitcoin ETF. I'm going to drop us back down to the daily chart. Here it is. There is Bitcoin. Bitcoin, if you look at this on the RSI, it's as strong can be. The signal line here on the MACD says it's as strong can be. The MACD histogram says it's as strong can be. So Bitcoin just in the midst of a massively strong uptrend, really not showing any signs of weakness, and continues to make new highs. As Jill was talking, we made a new high during the earliest session of the show. So Bitcoin still stays strong. Let's take a look at the DIA, which is the Dow Jones Industrial Average. Here is the DIA. We have a divergence on the RSI, showing that maybe stocks might be getting ready to pull back on the Dow Jones Industrial Average, or the DIA, which is the Diamonds Trust, which represents the Dow 30. Let's take a quick look at the Nasdaq 100, the QQQ. And sure enough, we have a very strong high and lower high, and a very strong divergence on the RSI on the daily, because you can see here we have a high and a lower high, and here you have a high and a higher high. And I'm just going to put one of our little trend lines on the chart and show you how you can use your Dash Trader charts to really do some advanced technical analysis. And I'm just going to double click on this, and I'm going to color code it so that not everything is yellow. It doesn't all have to be yellow. There it is. So now I'm just going to put another trend line on here. And I want you to see that. Notice that once I change the color of my trend line on one of the sections of my chart, it also carries through to the other section of my chart. So this is a divergence. You can see the trend line is going down here on the upper section, and here you can see the trend line is going up. So you can see that price is diverging from the RSI. Now, what's also very interesting is on the Nasdaq, we have a crossed over signal line on the MACD, and we also have the histogram has gone below the baseline, which is 0. So we've gone negative on the histogram. We've crossed over on. So from a relative strength perspective, the Nasdaq, which had been the strongest index, is now leading the way down. And I want to take one of the component stocks. Let's take a look at Apple. Here, Apple high, lower high. Apple looks like it's going to break lower. It's below its moving averages. The RSI is pressing near the lower echelon of the oscillator. And of course, the histogram and the signal line also says that Apple is looking fairly bearish. There's even a head and shoulders on the chart here. So if you notice, there's a head and shoulders on the chart. Now, the last thing we got is Facebook. Facebook, a massive down day today. dropped from 269 down to 261. It's an 8-point drop down in Facebook. And you got a high, you got numerous lower highs, lower high, lower high, lower high, lower high. And you have a crossed over signal line, and you have a now almost negative on the histogram as well. So Facebook looking like potentially coming into some bearish action here. So it's not just Facebook. Let's take a look at one of the strongest of the strong, right? We had Alphabet or Google. Alphabet or Google after the big gap up on their earnings, just getting under its first 10-period moving average. We're seeing this across the board on all of our indicators. You're also, let's take a look at, PayPal. This is a payment system. This is PayPal, also 4 down days in a row, starting to show signs of bearishness. And you can go across the board, and you're starting to see this kind of bearish action on some of the technology stocks that are out there. And I hope you guys found that this was an interesting little chart section today, explaining how to use the MACD and the RSI on our Dash Trader charts. I do have one more thing I want to take a look at is USO, right? And I'm going to also mention, so oil has gone to the highest it's been since the start of the pandemic. So oil kind of crashed back in, let me change this to my weekly chart. In the middle of the pandemic, we saw oil coming down to this all-time low, and then we've gotten all the way up here on oil, and sure enough, we've crashed, and now we've recovered quite a bit. But I think that we have some signs that oil might be slowing up as well. And the last one I want to look at is one of the ones that we mentioned right at the beginning of the year, which has made a tremendous run off those lows. The low that we had mentioned was 32 on ExxonMobil. And you can see that ExxonMobil has gone all the way up as high as 52, 53 on ExxonMobil. So certainly a nice recovery on ExxonMobil. And I hope anybody who read our monthly newsletter remembers that we had mentioned that oil and ExxonMobil particularly might be something that's worth taking a look at, as it had bottomed out and was showing signs of recovery. And that's pretty much it for the charts. Now I just want to go and jump right back here and talk a little bit about sharing the love. And sharing the love. Share the love giveaway. Congratulations, okay, to the winner of the Share the Love giveaway, which is Predagium. That's the name of the handle. Predagium was the winner of the Share the Love giveaway. Thank you so much for everybody who participated in this giveaway for Valentine's Day. We continue to we'll continue to have social media giveaways and contests throughout the year, so don't miss out. Stay tuned as we do other giveaways. But a very big congratulations to Predigium, who is the winner of the Share to Love giveaway, and certainly follow us on all of our social media outlets. And in case you don't remember or haven't signed up already, stay tuned to everything Dash Trader by going to the Dash Trader webpage, and you can go there by www.dashtrader.com. Subscribe to our YouTube channel at Dash Trader TV for Dash Trader Newsroom reminders. You can also follow us on our social media links on LinkedIn, Twitter, Facebook, and Instagram. Thank you so much for joining us. Stay tuned. We have a whole bunch of new educational videos coming out on different trading styles, and of course, configuring your Dash Trader charts, advanced Dash Trader chart configuration. I'll be teaching all about the different indicators, how to use them, and of course, how to configure your charts. So on that note, have a wonderful, wonderful weekend, and see you all in 2 weeks. Bye-bye.